you for joining the webinar today on balancing risk and growth, jointly sponsored by the ICPM and Brilliance Financial Technology. I'm delighted to introduce Michael Underwood of Brilliance Financial Technology, who will start us off on the webinar today. Michael?
Thanks, Marcia. And if we could just really quickly turn over the presentation to Clifton Chang. And Clifton, if you could bring up our very first slide, that would be great. And while we're doing that, I'm just going to say thank you and welcome everybody. Again, would really like to encourage this to be I encourage you to ask any questions that you might like. We are conducting today in more of an interview format. Today we are going to be really focusing on what recommendations will you make to your CRO and risk committees to balance risk and growth, we're going to include topics like how to prepare for the immediate uncertainty while meeting the pressure to support returns and net interest margin, the changing and new strategic role of the CPM group. As Clifton is getting ready to share the slides with you, a couple of other areas that we will cover today, including top priorities for credit portfolio management groups, and how can CPM get management resources and allocation and focus to ensure that it can fulfill its strategic responsibilities. So with that, for those of you that are not on the call, that are just dialed in, we're now going to go to slide number 2. So today's webinar is brought to you by Brilliance Financial Technology. And we automate the relationship-based pricing process, and in doing so, capture data that provides powerful analytics, helping our clients solve for optimal market pricing and increasing deal wins. And today we're interviewing Clifton Chang with Advanced Risk Consulting. Again, we're on slide number 3 now. Advanced Risk Consulting is a provider of real-world risk management experience and enterprise risk analysis, strategy, and governance. So today, in my role as head of business development at Brilliance, I really see 3 issues impacting banks. We are now on slide number 4. Really, over the past 2 decades, we've witnessed an extraordinary decline in both short and long-term interest rates from levels of around 4 to 6% to close to 0. And although recent declines have been associated with the financial crisis, the decline and its aftermath, the decline in yields, particularly from long-term rates, really began in the late 1990s, as this graph will show you from the central bank. Also, really, as part of my role in business development at Brilliance, I read hundreds of bank annual reports every single year. It's part of how I keep in touch and know what's going on at a bank. And one of the trends I see across all banks is that they are either expecting a very nominal increase in interest rates, and some are even planning on a no interest rate increase, basically taking an increase as a bonus. So the impact is banks are really finding it harder to be profitable, attract deposits, and frankly, it's adversely affecting the quantity of loans, it's suppressing returns, and it's making it more difficult for borrowers to secure loans. The other area we see is increased competition. And again, for those on a different call, we are on now slide number 5. Banks are seeing competition coming from multiple sides, including fintechs and shadow banking entities. In fact, a recent Fed statistic showed that in 2016, almost half of all credit amounts outstanding are not held by a depository institution anymore. So I predict that the ability to quickly collect, access, and process information from customers and ecosystem partners is going to become a key differentiator in the next 2 years for banks that really want to continue to compete. And what I already see today is, in regards to how banks are reacting, is I see they're creating portfolios of highly competitive, modular, unbundled offerings, which can be combined on an individual customer preference. I see investment in smart algorithms that use analytics to create product bundles around a customer's goals. And I also see kind of this increased target customer segments where savings from digital engagements are offsetting these higher cost credit costs to meet the long-term goals. And so long-term, I think banks are going to need to provide a seamless transition between products and channels, meaning digital and human. And they need to enable customers to self-customize the banking experience, i.e., build the product bundle that they want. The other area that I see that's really impacting banks is regulations, and I think we all know this, right? Regulations have had a dramatic impact on the overall cost of doing business. As part of the research that I was doing for this webinar, I found that between 2010 and 2016, The Economist estimated that the Dodd-Frank Act soaked up $36 billion, that's billion with a B, in compliance costs. And so even with recent changes in our, in policy, new administrative changes at the Fed level, regulations are going to continue, and banks need to be prepared to respond. As an example, CECL and IFRS 9, which were both rated as top concerns last year in the IACPM survey, and they're still drawing increased management attention and resources, and it's forcing banks to put new systems and processes and associated internal controls really into place. And so that will lead me to slide number 7 and my first question to Clifton, which is, Clifton, with the pressure from the market, competing technologies, and the ever-changing regulatory requirements, how should CPMs be advising their CROs?
Yeah, thanks, Michael. No, there's definitely a lot going on right now. And certainly in the last decade, we've seen unprecedented regulatory changes, and somehow we've found ourselves back coming full circle to standard capital. We now have leverage ratios, stress capital, and a regulatory framework, which has been, creating some existential questions for us, for CPM. And at the same time, we've had a Fed safety net, which meant we really didn't worry much about credit risk. That's in spite of some pretty big systemic scares and an epic, oil price collapse. So I can, tell you that, having sat through quarterly risk committee meetings over the last 5 or 6 years that were scheduled for over 2 hours, I think we spent maybe, 10 to 20 minutes on credit risk. And that discussion focused more on how to expand limits and loosen underwriting guidelines to maintain growth and not on problem credits or emerging risks. Of course, we obviously had some deep dives into oil and gas and some other sectors along the way. But once you're able to show that the losses were manageable, credit risk basically takes a back seat. And I guess that kind of hints at what won't change, which is that financial institutions are in the business of buying risk and will continue to seek to maximize revenues and net interest margin through the only 2 ways they can, which is grow the current risk profile or increase the risk profile through riskier credits and products and extending maturities. The difference from the last decade, though, is that on a go-forward basis, we may be pursuing these higher returns without a safety net and in a period of increasing macroeconomic uncertainty in domestic and global economic policies. Yet we still need to manage this process through all the noise. So that kind of leads me to my first broad recommendation, which is, we all expect the short-term and possibly extreme volatility, but the long-term goals will always remain the same. So the first broad recommendation for your CRO is to help them maintain focus on the long-term conditions and environment. The benefits from the proposed fiscal stimulus will be slow-moving and still mean a lower-for-longer rate environment that you talked about, Michael. And this means the competition for credit assets and higher-yielding credits on the cusp of acceptability will continue. With respect to regulatory policy changes, even if the Dodd-Frank Act is rolled back in some way, it's not likely that we'll see a return to 2006. And in other words, your risk strategy really shouldn't change if the regulators cut in half the capital any more than you would if they doubled it. And on the political risk side, it's obviously a source of some pretty high volatility with the prospect for short-term Twitter tantrums. But just as we try to quantify other unknowns, we've got the tools to try to identify the lasting impacts of these kinds of risks as well.
So first of all, Clifton, I got to tell you, I love the term Twitter tantrum, so that's great. So thanks for the laugh. But
sure.
So it leads me to another question, though. Understanding that specific strategy recommendations are really highly dependent on a bank's business and culture, what general measures can you take to support your CRO to drive that more long-term focus?
Yeah, so that takes us to the next slide 9. I guess the first recommendation. A lot of the recommendations I'm going to follow are about empowering your CRO, which is really providing the levers to support the CRO's risk agenda. And the most important support you can provide to your CRO for a long-term view is to help them formulate a long-term credit risk strategy. So, credit risk strategy recommendations need to be based on something, on some criteria. And certainly from risk point of view, reducing your risk to zero sounds like a good idea. But then we should just return the shareholders their money and go home. But actually, the responsibility of the shareholders does point us in the right direction. The criteria upon which we base our recommendations still all boil down to maximizing return on their capital at risk. And I know that seems fundamental, but yet many of us have been pushed away from the risk-sensitive measures to the point where in some cases we've abandoned our advanced model outputs and, importantly, the thought process behind them. The recommendation here is leveraging the macroeconomic uncertainty that we're facing now to re-promote the most risk-sensitive measure available for an enterprise view of the risk in your bank. So with the potential for a turn in the credit cycle and the uncertainty, there's no better time than now to request that support. And by using the risk-sensitive measure, we gain the confidence of the CRO and top stakeholders if we demonstrate we have an informed sense of the actual riskiness of the enterprise. And, even if you are still using advanced capital, the focus, and certainly in the U.S. banking market, is on stress capital. And we all have at a minimum available now these stress testing analytics. And in fact, the stress testing is required to be applied now in risk management and not just as a capital exercise. So it's actually a suitable risk-sensitive tool to apply.
So, Clifton, how do you recommend reincorporating the risk-sensitive measure into strategy using stress test outputs?
Yeah, so moving to the next slide here, the way to support the CRO in promoting risk-sensitive measures is to refocus our stress testing analysis to inform enterprise business strategy. I think the CRO's best and maybe only source for a true strategic enterprise risk view might be from the CPM or related function. I think a lot of firms have started or on their way, but actually making it happen requires communication and execution. So as you look on the left-hand side of the page here, I think, we spent the last 2 decades developing many of our reporting and analytical muscles. We're pretty good at identifying what our current loss is, who we are now, what our major revenue and risk sources are. Are we a corporate investment bank? Are we a residential mortgage and consumer bank? Are we a middle markets bank? I think a lot of us have been worried about turning into a commercial real estate bank in the last few years. On the large corporate side, CPM's involvement in deal review has given us some input on pricing benchmarks on a deal-by-deal basis. And we obviously provide some early warning and hedging analysis for sectors and products. But extending the analysis beyond just the large corporate portfolio is really critical.
So wasn't stress testing a big game changer for CPM?
Yeah, no, absolutely right. Because of the stress testing requirements, we now have the sanctioned tools to forecast losses on a prospective basis. Now, moving to the right-hand side of the slide, and doing so under stress. So, where CPM provides and assembles the key credit loss inputs from the various portfolios across the enterprise to generate the regulatory capital required under specific scenarios. But I think even more importantly is that it required incorporating the growth strategy and expected returns as inputs for the base case forecast. Now, moving down the page here. This is for a view forward into the business mix and the EL profile of the future portfolio. And by understanding how that base case portfolio behaves under stress, we can apply the stress test modeling not just for capital plan submission, but in the risk management process to actually inform the base case strategy. So you end up creating somewhat of a feedback loop between the stress testing and the base case strategy formation. We can also apply more advanced quantitative tools to the go-forward strategy, such as the simulated losses under multiple scenarios for EL volatility and for correlated risks. And we can also use those to inform the base case if we have those.
So Clifton, the quote that you have up at the top, I love it because it was actually, you said the same thing to me when I first met you at the IACPM last year in Washington, D.C. So the portfolio you construct today is the one that is subject to credit cycle tomorrow. So how can you use this window to really influence the outcome?
Yeah, so that takes me to the next recommendation on slide 11. And you're right, Michael, it's not enough just to do the analytics. I think we have to leverage our unique risk perspective to provide the comprehensive risk-return view of strategy for all users. Meaning, regulatory requirements extend responsibility for risk vertically up to the execs and the board and down to the front lines of business. The requirement to be on the same page. So the CRO can actually structure the risk management process to use the common CPM view to fulfill this requirement. The execs and the board need to know that the portfolio currently being constructed will continue to meet the stated risk appetite limits under base case scenarios and under less ideal credit conditions. Alternative titles to that slide could be, if every line of business conducts its own strategy, this is what the enterprise will look like under stress. Or alternatively, under CECL, this is how your portfolio valuation will change under stress. And if you describe the objective in this simple way, I think a common view becomes less of a threat and more of a positive push towards transparency. I can tell you, before we had the window into strategy, CROs, I think, were often limited to opining on specific credits, large deals, and product strategies. I think now that we have a window, the risk view of the strategy is required. But without the risk-sensitive analysis, it's difficult for the CRO to provide an opinion. And it's not easy. There are going to be battles about how to ascribe the risk and returns on the risk. In one organization, finance had 4 or 5 different ways of ascribing return. Some as inputs into RM compensation, but none of which really had a serious risk element. And we also found that the return info was only available by high-level business segments. Since finance didn't need a loan level or pool level information for its purposes. But we worked with what we had, and we used the business segment information to segment the return data for a simple view, and we applied our risk data to assemble a risk-adjusted view for the enterprise. And after some difficult and extensive socialization, the risk-return views were eventually presented in a formal committee setting, and the CRO found a voice to use in strategy discussions. As a side benefit, we also got resources to pursue more granular profitability data to refine the analysis. And we'll go through an example later of what that analysis looks like.
So Clifton, do you think most CPM groups are equipped to provide these common views in order to fulfill this strategic role that you've laid out?
Yeah, moving to slide 12 here, I think, many financial institutions have started the journey towards building the infrastructure to integrate into the strategy process and getting to that ideal state. But the journey is still unfinished. I mean, so many times, our infrastructure building has taken a backseat to the latest crisis, and most of us end up, being sent scrambling to produce the analysis du jour. And on top of that, the short-term cost focus from the last few years has favored brush fire management over investment in technology and in organizational change for any long-term cost benefits and process improvements. But I think that the need is becoming more urgent. Yeah.
Yeah, I was just going to say, I love the idea of the current, what's the problem du jour. So, if you're trying to fight that, that kind of reactionary, and I agree with you, it is urgent. Where do you recommend that CPM start? Yeah,
the 3 key elements that I think about as getting to this target state are usually in place, but only sort of partially in many cases, and often through some costly manual processes. So the first one is the one on the far left here, which is what I call enterprise risk analysis. And that really just means taking your risk and return data and accurately aggregating it on an apples-to-apples basis so you can compare the risk and rewards across all products and businesses in the enterprise. So that's obviously essential to strategic decisions, understanding where you're starting from. But it's also critical for supplying the correct inputs for stress testing and other risk analysis. And for CECL, for example, across products and businesses. So it's already a priority for regulatory compliance. We need the open analytics with flexibility to accept a variety of risk and return metrics, whether you're using RWA or stress capital or simulated losses, and whatever your preferred return metrics are. And then finally, we need to include the external market pricing data for early warning processes and hurdle rate analysis, and for tracking performance of actual relationship returns against targets.
So where do you start the data aggregation process?
So, I think everyone has some room for improvement on data quality, but assuming you have some minimum level, the next piece is to integrate across the enterprise, and that's from consumer to wholesale and corporate businesses. But it's also important from front to back for the entire loan life cycle. And one of the reasons why I'm partnering with Brilliance today is that they provide a piece of that puzzle by automating the data integration and by providing the risk return and analytics at the front end. There's often a missing link between the CRM pipeline process and then the final risk approval and operational booking processes. And those are key pieces for tracking the actual relationship returns historically against targets. So in the chart above, and this is a simplified version of what I've seen Brilliance present in other venues. You have the CRM side on the upper left-hand corner, which has all the marketing and the initial pricing aspects, and that feeds into their deal point pricing platform in this example. But also, as importantly, once the deal is actually approved and approved as priced, that data also gets forwarded into deal point. And after it's booked, and in addition to the other whole world of data that exists to feed the data mart then also can get pulled in to the pricing platform. And you also have this cloud here of the external data sources to pull in market pricing. And as a result, you end up with an aggregated data and analytical base to feed your reporting services for this common view that I was talking about. It's a great example of integration and automation at the front end here. I will say that in deal committee, where a lot of this kind of stuff ends up getting used, the discipline I've seen is actually pretty good regarding the relationship strategy, but the devil's in the details. And I think, often approvals are based on promised future income, which are probably tracked on a spreadsheet, but not systematically. So there's no real transparency to check if the relationship or business strategy is working. So that takes me to the next slide and the next recommendation. And now that you've had the automated integration, which we now know is key, but how does it specifically help your CRO? So now that you have the fully integrated data, it means you can leverage the risk-adjusted returns to finally seek to rationalize the compensation structures to risk appetite and targets. And I know this is a very difficult topic, but it's an essential one. And it's not often followed through as far as it can. I think some institutions have certainly made some progress here. But it's a key reminder for CROs to keep it at the forefront. And the right technology is critical to this objective.
So Clifton, banks are going to expend resources on regulatory mandates for capital plan stress testing, or accounting rule reforms such as IFRS 9 or CECL, or even, as you said, the current all-hands emergency. How does bank risk management move from that traditional short-term tactical approach to a more longer-term focused strategic approach?
Yeah, I definitely need the management allocation of the resources to invest in the technology and processes. Aside from the cost savings from capital efficiency through strategy improvements, I think the clear benefit is that institutions will benefit from the long-term cost savings from the efficiency through integration and automation. I know it's a bit of a chicken or egg problem, so it's important to tie the management's intense short-term focus on CCAR or CECL or whatever it is by tying them to the long-term resource needs that will allow the organization to really get back on the right foot so that it can be proactive. And that's the next recommendation, which is leveraging the CCAR or whatever your current regulatory imperative is to seek support for improvements in data aggregation and processing, not just for the specific fire drill exercises, but for the overall risk infrastructure to be able to respond effectively. Instead of spending massive dollars actually on patches for MRAs or MRIAs, give your CRO a plan to justify the resources for long-term process improvements that lead to a more proactive stance. And by the way, it's less of a direct imperative, and I didn't mention it specifically here, but, you talked about the competitive pressures. You can also leverage competitive threats from fintech risk technology that could compete directly with traditional banking technology. As you said, competing effectively will mean changes in our data processes and in what strategies we undertake. So, whatever the regulatory imperative or competitive threat, a proactive stance is a critical piece to integrating business strategy with risk, which is the next sort of key element here on slide 17. The second key element is risk strategy development. So you've done all this work in enterprise risk analysis, and it becomes more valuable when you bridge it, the risk and return dimensions into the business strategy to create a relative value view of your strategy options. CPM already provides the key inputs and analysis for these credit loss exercises, for stress testing, and all the ad hoc sector deep dives that we've done, for oil and gas or metals and mining, CRE, subprime auto, and so forth. So we should leverage our data and analytical research needs to support the building of efficient and flexible processes to respond to any emergency by establishing our role in the strategic discussions. And, a simple example would be to create analytics showing the impact of stress testing on portfolio risk-adjusted return to evaluate business strategy.
So I think that's a very interesting idea, Clifton. Can you give an example of incorporating stress testing results into analytics?
Yeah, let's go to the next slide. And it's going to give you a visualization of strategy tied to stress testing, and it's the kind of analysis that I referenced earlier, to give your CRO a risk strategy voice. It's a simple example, but it's your standard, risk return graph where you have the return on the y-axis and relative riskiness on the x-axis, and you can use any measures you like, whatever's available and customary for your firm. But let's take a look at the base case scenario. So your portfolio, enterprise portfolio, is the large blue circle, and it has the sort of average risk return designated by that orange X in the middle. But we've also broken it out in your three major business lines. So let's see what happens to the business lines under stress. You see the portfolio obviously moves down to the right due to the stress scenario. But what's more interesting is what happens to the individual business lines. So we see here that the largest business line 1 in red, was the most sensitive to this particular stress scenario. And again, it's something you might expect because you've designed your stress scenario to affect it this way. But maybe more interesting is that business line 2, the blue, ends up not being as sensitive, and maybe there's some benefit there. So it definitely starts the discussion.
So, presumably this could be applied to even much more complex portfolios.
Yeah, absolutely. And, I've helped clients pull together appropriate views for sub-portfolios and other segmentations, including loan type or asset class. And, I've done versions with 20 or more bubbles, which really enhances the differentiation. So let's look at a business segment example, a simple one. And here's an example of evaluating a strategic alternative for a line of business using stress test analytics, in this case for a CRE portfolio. So again, we have the same kind of risk-return graph, and we have the total CRE portfolio under the base case now on the upper left-hand side, again with the average risk-return profile marked by the orange X. And then we have each of the businesses, each of the food groups in CRE here represented as well. So under the stress test, under the current strategy, let's call it strategy X, we see how the various property types move down and to the right. Obviously, the portfolio risk-return profile degrades, and the business segments degrade as well, but in different ways. So we see multifamily, in this example, doesn't move quite as much, whereas retail is the most sensitive, moving quite a bit. So, based on this view, maybe we consider under the same scenario using a slightly different strategy. We'll call it strategy Y. So let's do a little bit more multifamily, maybe the same amount of office, a little bit less other, and a lot less retail and industrial. So what happens to your portfolio average then? Well, actually, you can actually improve the portfolio average and reduce the sensitivity of your CRE portfolio to that particular stress scenario. And that could be a positive thing. If that's your objective, you may end up actually recommending then your strategy Y over strategy X.
So this is really, if I boil this down, Clifton, it really is about being proactive, right? And so presumably instead of stress testing, you could use this visualization to show impacts of CECL, IFRS 9, oil price scenarios, and other various measures of risk and return.
Yeah, absolutely. You can apply this, obviously, using your internal stress testing scenarios. You can apply a CECL lens or any other portfolio credit loss analytics that you have. And you can imagine doing this in a very granular way for all the individual business segment strategies. And you're right, the important part is providing transparency on a proactive basis, which leads to the next recommendation here on slide 20, which is supporting business strategies that improve the portfolio. And that's the proactive piece. And what this means is giving your CRO a way to support positive business initiatives. Now that you have the strategy comparison view, you can be proactive about supporting strategies with better relative value, especially where, the new business initiatives lead to increased diversification for the overall portfolio or to reduce sensitivity of the portfolio under stress, if that's your objective. Or maybe if you're using a CECL lens, maybe you can use this to figure out the amount of committed lines you need to convert to guidance lines to lessen the impact of seasonal. Or maybe, how many more shorter dated consumer or CRE assets you need to build into the portfolio to lessen the impact of CECL. One thing that we did was to use the analytics to support outside strategic relationships that are justifiable on a risk-adjusted return basis. In one firm that I work with, the obligor concentration limits were EC-based, so it could easily show which client relationship returns could justify a sizable limit exception and designate those relationships as strategic partners. This is an important part of their business strategy to become more meaningful to fewer clients in order to capture the cross-sell fee business. And it was interesting to see which handful of clients ended up making the cut, and I think fewer did than the business expected. But they got bigger lines where they were warranted, which I think they felt was a victory, and it was compliant with the risk agenda as well. And I know putting together these views are not easy, but if the executive support is there and the approach is right, organizations will move in this direction. I think it's also interesting to see how competitive business heads get when you have your socializations discussions with them. The guys that look good usually gloat a bit and try to use it as leverage, which is fine. That's the purpose. The poorer performers by these measures are usually good at explaining why you're wrong, but that's also okay in the sense that the communication with their business is open and that's an important benefit, and maybe you can improve your analysis. And basically, transparency itself is a benefit that supports better decision-making by everyone.
So, Clifton, you've talked about infrastructure, you've talked about strategy. I think what comes next really is implementation and how it should be implemented. Any recommendations?
Yeah, this is the payoff here. After all the hard work that's done, doing the socialization and the analysis, making sure the input is given fair consideration by embedding it into the governance process. So this is the final recommendation here, which is embedding the CPM views into the strategy governance process. It's about becoming the source of transparency into the risk impacts of business strategy on the portfolio. And it's incorporating these views into the risk governance process, whether through policy or required committee presentations, strategy committee approvals, anything formalized. Transparency is the important foundation for effective review and challenge of strategy, which is another regulatory principles-based regulatory requirement. So that's the last and the final key element that we talked about, which is risk governance. And it's about integrating the enterprise risk analysis and risk strategy development that we've done into corporate risk strategy processes, so everybody understands and is on the same page regarding the risk and returns. And it's also about providing consistent reporting and business intelligence views for transparency at all levels, down at the deal committee or to credit approval or to the ExCo and board level communications.
Okay, so, Clifton, there's this principle-based regulatory requirement that everyone needs to pay attention to risk. Does this risk governance process, help meet that requirement?
Absolutely, and it's by design. The views will also tie into risk identification, risk appetite, and the regulatory requirement to integrate the risk tools in the strategy. So the lines of business, their subdivisions, and even the RMs will need to know how they're performing on a risk-reward basis relative to others as the transparency increases. And in the end, the execs and the board are fully aware of all the business initiatives and their impact on risk and return. So you end up having your risk and return data fully integrated and fully understood and communicated.
Okay, so, I think what we've seen is that earnings pressure for banks and financial institutions are not going to end. And we've also seen that with the potential for increasing credit and competition risk on the horizon, I think it's becoming increasingly urgent for credit portfolio management groups to act strategically. So how would you sum up final recommendations, Clifton?
Yeah, so as I said at the beginning, I think the recommendations all boil down to empowering your CRO to maintain a long view despite all this noise. And that means to give him the tools to get everybody on the same page by providing a clear and institutionalized long-term vision of risk and strategy. And also to get the resources by leveraging the macroeconomic uncertainty, the known regulatory requirements, and the competitive threats to fill a need for a common risk-based view of the way forward for the enterprise. And ultimately, to get on the right foot by ensuring a proactive capability to visualize the impacts of any potential change in the environment. I mean, we spent the last few years responding to constantly changing regulatory requirements. I think it's time we tried to get on the right foot. And I know these topics are familiar to all of you, but offering the leverage to your CRO is vital to the execution. And it really is all about the execution, getting it done. And if you do get it done, the integration and process improvements will lead to efficiency and cost savings. Your organization will gain institutional transparency and compliance with regulatory principles-based requirements under any regulatory regime. And with the appropriate risk strategy framework, the CRO can actually support prudent growth while preserving safety and soundness in an uncertain environment.
So, Clifton, I want to say thank you for participating in this webinar and letting me interview you. If I were to sum up what I've learned today, putting proper aggregation, strategy, and governance in place is going to equate to efficiency, greater ability to meet regulatory requirements, greater transparency, and higher earnings potential. So thank you. Team,
thank you, Michael.
I would also like to now open this up to anybody that may have questions from that has been on here. I would like to also just address one comment that we got. I do apologize if anybody found the Twitter tantrum as a bash to President Trump. That was not our intent. Our intent was just to make something funny and anecdotal about having to manage risk in different areas going forward. So I do apologize if anybody took offense to that.
Yeah, and that was mine, Michael, and I apologize too. It wasn't meant to be mean, but obviously it could be taken that way. So apologies.
Yeah. All right. So with that, again, I'd like to open up to questions. So how do you get everyone involved to pay attention to that risk governance process? As an example, how do you get the originators that are more focused on volume and less on risk? It kind of goes back to one of your earlier recommendations.
Yeah, that's right. I mean, as I said, I think we've been working towards changing the compensation structures to be aligned with some of the risk targets. And, we've obviously seen when compensation structures are not aligned what potential damage it can lead to. But it's important to move forward and, again, to keep that topic at the forefront. I don't think we're going to change compensation structures in the industry, but what we can do is we can align them more by showing the relative performance of certain kinds of products or strategies against the risk.
Okay, thank you. With that, I'll ask, does anybody else have any other questions? If you would like to discuss any of Clifton's recommendations, please feel free to reach out to him at Advanced Risk Consulting. His contact information is here. If you'd like to discuss or like more information in regards to automating and providing analytics with your front-end risk-based pricing process, please feel free to reach out to me. And actually, I do have one other question. Sorry. Do you recommend any tools that can help assess data integration capabilities at a bank? We find this to be a serious issue.
Well, from my standpoint, and Michael, you may have a better answer here, but there's certainly tests that you can do to assess, where you are, and a lot of this relates again to the stress testing. And if you don't have the resources, definitely fall back on the stress testing requirement to supply supply accurately integrated data in your stress testing exercise. So there are certainly tools to use there. And I don't know, Michael, if Brilliance has any solutions.
Yeah, it's a tough question to answer. What I've found is that banks, what I'm hearing from your question is that how do I normalize my data? How do I make sure that my data is, I'm able to normalize it? And I think a lot of banks have challenges with that. And it's not an easy way. And so you do have to start with clean data. I'm not aware of any tools that will help you actually, normalize and clean that data. I just got another email question. Let me just go to it really quick. Clifton, this one's probably more right up your alley. What is your view on the implementation of using economic capital versus RWA for setting credit limits or doing various loss forecasting?
Well, yeah, as I said, I think we've kind of, in some cases, by being pushed toward the standardized capital. Sorry, getting a little feedback here on the phone. Okay, so by being pushed towards using more standardized capital, I think some of us have kind of abandoned our economic capital modeling, which is which in some sense, and I know it's controversial because it's modeling, but so is RWA. It's just a more standardized form of modeling. So if you think about, it's what you have available. I mean, I happen to be a proponent of using more advanced tools. That's clearly not necessarily in vogue, but I think this is the one that you need to use in an environment like this. So, when we think about standardized capital, it's sort of a top of the house type measure. This is the total amount of capital that you need to hold in order not to fail under an extreme stressful scenario. But it really shouldn't be helping you decide on a deal by deal basis what deals you're selecting, and ultimately it's fine that so when we hit that stressful situation, your bank won't fail, but your shareholders are not going to be happy because in the end you've just absorbed an extreme amount of losses instead of selecting the right risk-adjusted return. So RWA, getting back to RWA, if you have that, you can use that. If you have EC, though, I'd highly recommend using EC. But that's that's a battle that you'd have to fight internally, and it's fought often. So.
Okay, thank you, Clifton.
Great.
And for everybody, we actually did email this presentation out. If you'd like, if you would like another copy or you can't find it, please feel free to email me, Michael@bxfin.com. But there was also sent, Marcia, was it sent with? I think it was sent this morning, correct, to everybody that had registered?
Yes, it was sent to those who registered. We will also be posting the webinar on the ICPM website a bit later this week, and we'll send out an email notification to all who had registered for the webinar for that as well. So feel free to contact either Michael or Clifton for more information, or look for the email from us at ICPM regarding the posting of the webinar and the presentation information.
Okay, wonderful. Well, I want to thank you, and I would like to go back and just I did forget one little thing at the very beginning, and the reason I wanted to interview Clifton Chang is Clifton does have over 25 years of credit risk management experience, a long-time member of the IACPM, and most recently was managing director for J.P. Morgan Chase for portfolio management. And head of credit portfolio management strategies at Union Bank. So I want to, again, thank you, Clifton, for your time. I want to thank everybody for their time in attending our webinar. And, again, encourage you, any questions about what Clifton said, to please contact Clifton directly at Advanced Risk Consulting, or any questions about how you could automate your front-end risk and relationship-based pricing, please contact me. And thank you very much for your time, everybody.
Great. Thank you very much, Michael and Clifton.